factors and emotional biases. Loss aversion is the first of 6 emotional biases, and emotional biases are harder to correct than cognitive errors because they originate from impulse or tuition rather than conscious calculations. And loss aversion was identified when Kahneman and Tversky were working on prospect theory. In prospect theory, loss aversion bias is a bias in which people tend to strongly prefer avoiding losses as opposed to achieving gains. Psychologically, losses are significantly more powerful than gains. Rational investors should accept more risk to increase gains, not to mitigate losses. However, investors tend to accept more risk to avoid losses than to achieve gains. Loss aversion leads people to hold their losers even if an investment has little or no chance of going back up. Similarly, loss aversion bias leads to risk avoidance when people evaluate a potential gain. Loss-averse investors have a tendency to sell these investments and realize their gains to avoid any further risk. But by selling the investment, not only is the potential future for losses eliminated, but also the potential for future gains. So one study has estimated that losses are felt 2.5 times as much as gains of the same magnitude. And when it leads investors to hold on to losing positions irrespective of its prospects, that's called the disposition effect, and we will be discussing this as well. The impact is that it limits the upside potential of a portfolio by selling winners and holding losers, and these investors with loss aversion also tend to overtrade. They sell winners when they don't need to. The disposition effect, as we just mentioned, is where most investors will go to great lengths to avoid selling for a loss and are quick to sell for a profit. For example, if you were to buy a share at $30, it drops to $22 and then rises to $28. Most do not want to sell unless it gets above $30. What is special about $30? Shouldn't you check your valuation of the share? Maybe $28 is a fair price. This same phenomenon has been documented in futures traders by showing that they hold losing positions longer than winning positions. So the consequences of loss aversion and the disposition effect are that investors hold investments in a loss position longer than justified. They might sell investments in a gain position earlier than justified. It limits the upside potential of a portfolio by selling winners and holding losers. Investors may trade excessively as a result of selling winners, and they hold riskier portfolios than is acceptable. It can be overcome by analyzing investments and realistically considering the probabilities of future losses and gains, which may help guide the investor to a rational decision. And this is a quote that more money has probably been lost by investors holding a stock they really did not want until they could at least come out even than from any other single reason. If to these actual losses are added the profits that might have been made through the proper reinvestment of these funds, if such reinvestment had been made when the mistake was first realized, the cost of self-indulgence truly becomes tremendous. Overconfidence. So many people tend to be overconfident about the accuracy of their predictions and of their judgment. A recent survey had over 70% of people classify themselves as better than average drivers. But of course, most people are around the average. Overconfidence is most likely after a series of successes and can lead to excessive risk-taking. Overconfidence can be used to explain why most investors have too little diversification. They tend to underestimate risks and overestimate expected returns. So essentially it's when people demonstrate unwarranted faith in their own intuitive reasoning, judgments and/or cognitive abilities. This faulty reasoning is combined with a gut feel and hope. Hope frequently underpins the probabilities assumed when investment decisions are made in an overconfident state. Investors may underestimate risks, particularly downside risks, because they assign probabilities that are too low because of overconfidence, and vice versa. An example would be that having decided that a company is a good investment, people may become blind to the prospect of a loss and predict high returns with virtual certainty. They are disappointed and hence look for a replacement that can generate high returns. People susceptible to certainty overconfidence often trade too frequently. The consequences are that these investors underestimate risks and overestimate expected returns. They hold poorly diversified portfolios, they might trade excessively, and they experience lower returns than those of the market. It can be overcome by reviewing trading records, identifying winners and losers, and calculating the portfolio performance over at least 2 years. A conscious review process will force investors to acknowledge losers and the amount of trading. And a review may reveal some trading rules to stick by to help overcome bad habits. Self-control bias is when people fail to act in pursuit of their long-term overarching goals because of a lack of self-discipline. Some examples that we might be familiar with are regarding money, weight loss, smoking, and studying. Sacrifices in the present require much greater payoffs in the future, otherwise people will not be willing to make current sacrifices. People spend today rather than save for tomorrow. Consequences are that investors might have insufficient savings for the future. People may accept too much risk to make up for less than adequate savings. Also, asset allocation imbalances. Investors might favour income-producing assets but not investing in growth assets to maintain spending power after inflation. It can be overcome by setting a budget and proper investment planning. As I say, failing to plan is planning to fail. The status quo bias is when people do nothing instead of making a change. If a given situation is the default choice, people will frequently let that choice stand out than opt out of it. The positions are maintained largely because of inertia rather than conscious choice. The consequences might be unknowingly maintaining portfolios with choices inappropriate for their circumstances and failing to explore other opportunities. It can be overcome with this education, especially studying up on the advantages of diversification and proper asset allocation. The endowment bias is when people value an asset more when they hold the rights to it than when they do not. There is an emotional attachment to goods and assets that they hold or have a right to. And thus there is resistance to sell even with potential losses. If we think back to traditional economic or finance theory, the price the person is willing to pay for a good is equal to the price at which the person would be willing to sell the same good. However, psychologists have found that the people tend to state minimum selling prices for goods that exceed the maximum purchase prices they are willing to pay for the same good, i.e., they might be state that they're willing to sell a good for $15, but they're only willing to pay $10 to buy the same good. In traditional economic theory, this makes no sense, but having owned the asset, they endow it with added value. And this is particularly true for inherited investments. There is resistance to selling even in the face of poor prospects. The consequences might be that people fail to sell certain assets, and they continue to hold assets with which they are familiar. It can be overcome by the investor asking themselves questions as to how much they would invest the same amount of cash that is the value of the inherited asset, finding a way to moderate the attachment to the asset, and finding a way to address the desire for familiarity by reviewing the historical performance and risk of the unfamiliar securities in question and contemplate the reasoning underlying the recommendation. And regret aversion bias is where people avoid the pain of regret associated with bad decisions. So people tend to avoid making decisions that will result in action out of fear that the decision will turn out poorly. There is a reluctance to sell because they fear that the position will increase in value and they will regret having sold it. Thus they hold on to positions too long. And they may also engage in herding behavior. And herding behavior is where investors invest in a similar fashion and in the same stock as others. They follow the herd. And this alleviates some of the burden of responsibility for due diligence with their asset selection. The consequences might be that they're too conservative in their investment choices and they engage in herding behavior, and it can be overcome by education, especially concentrating on the benefits of diversification. So when it comes to emotional biases, when possible, focus on the cognitive aspects of the biases. That strategy might be more effective than trying to alter an emotional response. Education is key. The most effective strategy is to ask questions to potentially alter the decision-making process of the individual, rather than being blunt about the emotional biases, because they can get defensive.